Every year around this time, we are often bombarded with reminders to put money into our RRSP. But what if you want to take some money out of your RRSP for other use? When you withdraw money out of your RRSP, it is 100% taxable, and therefore it's important for you to know how to utilize RRSP wisely. If you're not using RRSP with careful planning, it could potentially work against you instead of you benefiting from it. There are a couple scenarios where you may be able to withdraw money out of your RRSP without incurring any tax penalties. My name is Sandy Gum, and in this episode of Real Money Real Talk, I'm going to teach you how you can withdraw money out of your RRSP more tax efficiently in different life scenarios. If you're a first home buyer, you may be eligible for home buyer's plan. Home buyer's plan is one of the scenarios which allows you to withdraw from your RRSP registered retirement savings plan without being taxed to buy or build a qualified home for yourself or for a related person with disability. You may withdraw up to $35,000 as of 2020, tax-free per person. If it's a couple, you may withdraw in a total of $70,000 out of your RRSP towards buying a home. You're considered a first home buyer if you, in the 4-year period, you did not occupy a home that you or your spouse or common law partners own. In the 4-year period, begins on the January the 1st of the 4th year before the year you withdraw the funds and 31 days before the date you withdraw the money. For example, if you withdraw money out of your RRSP on March 31st, 2020, the 4-year period begins on January the 1st, 2016 and ends February the 28th, 2020. Here are some of the requirements to be eligible for a home buyer's plan. First, money must be deposited into your RRSP registered retirement savings plan for at least 90 days. You must intend to live in the house when purchasing. And the amount withdrawn under the home buyer's plan must be repaid back on a non-deductible basis to an RRSP. You will need to start your repayment the 2nd year after the year you withdraw money out of your RRSP. This means if you use home buyer's plans to buy or build a home in 2020, you will not need to start the repayment until 2022. You have up to 15 years to repay back the amount you owe, and you must pay at least 1/15 of the total amount you borrowed for the home buyer's plan. If you do not do that, you will then need to include the rest in your annual income. If you have participated home buyer's plans in the past, you may be eligible to participate again once the 4-year period passes. You also need to make sure that the balance is 0 on your home buyer's plan before you can participate the second time. For example, if you sold a home in 2014, assume your balance is 0, you may be able to participate the home buyer's plan again in 2019. If you sold a home in 2015, for another example, assuming again balance is 0, you may be able to participate again the home buyer's plan in 2020. If you are thinking to take a second degree or upgrade to a master or PhD, you may be eligible for Lifelong Learning Plan, LLP. The Lifelong Learning Plan is another scenario where you can take money out of your RRSP without taxation to finance a full-time education or training for you or your spouse or common law partner. However, you cannot participate in LLP for your children's education. Regarding children's education and training, I will cover that in my future episode under the RRSP Registered Education Savings Plan series. To participate Lifelong Learning Plan, you will need to receive a full-time basis offer before March of the following year. You will need to enroll with the qualifying educational program at the designated educational institution. However, if you have a disability condition, you can enroll on a part-time basis. You cannot participate LLP if you have already completed the program and are no longer enrolled. You can participate LLP as many times as you want over your lifetime. Starting the year after you bring your LLP balance to zero, you can participate the plan again. You can also participate LLP even though you may withdraw money out of your RRSP under the home buyer's plan that have not been fully paid. Similar to home buyer's plan, you must to have your money deposit in your RRSP for at least 90 days. You can have withdrawal up to $10,000 for the calendar year and a total of $20,000 out of your RRSP. Amount withdrawal under LLP must repay on a non-deductible basis to an RRSP over a period to not exceeding 10 years. You have up to 10 years to repay for the amount you withdraw, starting the 5th year after your initial withdrawal, or the 2nd year that you are no longer able to claim the educational tax credit, whichever is sooner. Each year you need to pay 1/10 of the total amount you withdraw until the balance being paid off. For example, Tina makes LLP withdrawals from 2016 to 2019 and continues her education from 2016 to 2021 and is a qualifying student up to tax year 2019. Her repayment period begins in 2021, which is the 5th year after the year of her first LLP withdrawal. Another example, Danny makes an LLP withdrawal in 2018 but completes the education in 2019. He is not a qualifying student for the 2020, but Danny's repayment period begins in 2021. You do not need to wait until retirement or age of 65 in order to take money out of your RRSP. There's no limitations or rules when you can take your money out of your RRSP unless it's a lock account. So what would be other scenarios that you can take money out of your RRSP without much taxation? Now remember, RRSP is all about contribute when your income is high, take out the money when your income is low. So you should ask yourself, when will be the situation that your income is low? You may also consider whether it makes sense for you to take money out of your RRSP in your 50s rather than waiting until age of 71 or age of 65. Because your income might be potentially high as a result of getting income from old age security and Canada pension plan. Here are some of the scenarios when your income could be potentially low. When you take 1 year off for vacation or traveling, when you're on maternity or paternity leave, when you go back to school and only work on a part-time basis, when you suffer health issues and you can't work that much, or maybe that you have family emergency that you have to step away from work. So to recap, when your income significantly drop than your active working status, that's when you maybe want to consider to take money out of your RRSP to supplement your income. So do you think some of those scenarios could be applicable to you? In summary, RRSP is a great tool to help you save taxes if you know how to utilize effectively and efficiently. If you think that this video helps you better to understand RRSP, how it works, and how to withdraw money out of your RRSP more tax efficiently, please help me share. If you want to find out more about finance and money management in general, click the button subscribe my channel. I will be releasing my videos every Wednesday.